All right, today we're diving into something really fascinating, the Inner Circle Trader Framework. Now, this is a methodology that basically claims to decode the hidden language of the market. The whole idea here is that if you can understand how the big institutions operate, you're going to start seeing price in a completely new way. It's a total paradigm shift.
So let's just kick things off with a huge question, one that really sits at the heart of this whole approach. What if? What if the price movements you see on your charts every single day, what if they aren't random at all? I mean, what if it's not just noise? What if every move is deliberate, it's precise, and it's all delivered by an algorithm? That's the core idea we're going to unpack right now.
Okay, now before we get into the really good stuff, we've got to do the quick legal bet. You know the drill. All trading has substantial risk. Everything we're talking about today is for educational purposes only. It's definitely not investment advice. Past performance doesn't guarantee anything for the future. So please always trade responsibly. All right, with that out of the way, let's get to the good part.
So here's what we've got on tap. First, we're going to talk about the trader's mindset, the core philosophy. Then we'll break down the 4 market states. After that, we'll dive into how you can actually read the clues that institutions leave on the charts. We'll also cover price, value, and liquidity, which is super important. And finally, we'll wrap it all up into a daily trading framework. So let's jump right in with the mindset.
All right, Section 1, the trader's mindset. This is all about changing the way you look at a chart. The core idea, the big one, is that price isn't just chaos. It's not the result of a million people clicking buttons randomly. Instead, it's delivered with a purpose, with a specific underlying logic behind it.
And that logic? It actually has a name. It's called the Interbank Price Delivery Algorithm, or IPDA for short. Now, according to the theory, this is the engine that actually delivers price to all the big banks and financial institutions. You can almost think of it like the market's operating system. And understanding how it works, well, that's the key to this whole thing.
Okay, so if there's an algorithm driving the price, what does it actually do? Well, that question leads us right into the 4 market states. These are like the 4 fundamental gears of the market. Every single movement you see on a chart, and I mean every single one, falls into one of these 4 conditions. First up, we've got expansion. This is that moment when price just takes off. It moves super quickly and with real purpose away from some kind of equilibrium or balance point. And this isn't just random volatility, okay? It's a clear, powerful, directional move. And here's the really cool part, the key takeaway. An expansion isn't just price moving, it's seen as a signal. It's like the market makers are finally showing their hand. They're telling you, hey, we intend to reprice this asset over here. The most important thing to get is that it's a deliberate, intentional act. All right, next up we have retracement. So after you get one of those big, powerful expansion moves, you'll often see price kind of pull back into that range it just left. Now the key here is that this is not a change in direction. It's more like the market is going back to do some business at prices it just sped past.
And this really gets to the heart of it. A retracement is basically the market makers going back to fill in the gaps, to trade at levels that weren't priced efficiently on the way up or down. They're looking for what's called fair value before they get ready to continue that original expansion move.
Okay, our third state is the reversal. And this is a big one. This is a genuine U-turn in the market's direction. But what's really, really important is when it happens. You'll often see a reversal right after a sharp move that punches through an old high or low, a move that's specifically designed to trigger all those stop-loss orders sitting there.
And the reason a reversal is so powerful, at least according to this framework, is because it's a massive signal. Once that key level of stops, or what we're going to call liquidity, has been grabbed, that action literally fuels a big sustained move in the other direction. So let's be clear, this isn't just a small pullback. It's the start of a whole new story for price.
And last but not least, we've got consolidation. You know what this looks like, right? It's when price just gets stuck, moving sideways in a tight range. Now, to most people, it looks like the market is bored, like nothing's happening. But from an institutional point of view, something incredibly important is going on under the surface. And here's the secret. Consolidation isn't the market taking a nap. It's a period of accumulation. The market makers are just letting orders pile up on both sides of that range. All those orders, that's the fuel for the next huge expansion. So think of consolidation as a spring being coiled. It's just getting ready for a massive release.
Okay, so that's the theory, the four big states. But the real question is, how do you actually use this? How do you apply it? Well, now that we know what the market does, we need to learn how to spot the footprints, the clues that institutional money leaves all over the chart.
So, here are the main things your eyes should be glued to. First, old highs and old lows. Why? Because that's where all the stop orders are sitting. We call these liquidity pools. You also want to watch for clean highs or lows, where the price has bounced off perfectly a few times. Those are magnets. And finally, those really sharp, fast price moves, they create something called a liquidity void, and we'll circle back to that. Basically, these are the landmarks on your map.
And this leads us perfectly into the three concepts that really help you build an actual trade idea: price, value, and liquidity. Look, if the four market states tell you what the market is doing, these concepts, they help you figure out where it's probably going to go next.
Let's start with value. It's actually super simple. Take any price range, from a low to a high. Find the halfway point. That's called equilibrium. Now, anytime price dips below that 50% level, it's officially in a discount zone. And that's exactly where you should be hunting for buy setups. I mean, who doesn't want to buy something on sale, right? You're buying it wholesale.
And on the flip side, if price rallies above that same halfway point, that equilibrium level, it's now in a premium zone. This is where you want to be looking for sell setups, because now you're selling at a full retail price. The whole concept just boils down to this: buy cheap in a discount and sell expensive at a premium. Simple as that.
So you might be wondering, where does the market get the gas to make these big moves? The answer is liquidity. And liquidity pools are just a fancy name for places on the chart where a ton of stop-loss orders are all clustered together. Where are they? Almost always just above an old high or just below an old low. The algorithm is programmed to hunt for these pools because they're the fuel it needs to start a big move.
Hey, remember those super sharp price runs we talked about earlier? Well, when price moves that fast in one direction, it leaves behind an imbalance, an inefficiency in the market. We call these fair value gaps, or sometimes liquidity voids. And the crazy thing is, price acts like it has a memory. It often gets drawn back to these gaps like a magnet to fill them in and rebalance things.
All right, let's tie all of this together now. We've got the four market states. We have our key institutional reference points, and we understand the concepts of value and liquidity. So how do you actually combine all of this into a framework that you can use like every single day to look at the market?
And really, this is the ultimate goal, the big takeaway. Once you start thinking this way, once you put on these institutional glasses, that fear of missing out, it just evaporates. It's gone. Why? Because you realize the setups, the expansions, the retracements, the reversals, they aren't rare. The algorithm delivers them like clockwork every single day. The opportunities are always there.
So you see, this isn't just about learning a few new patterns. It's a fundamental shift in how you see the market. It's about going from being someone who just reacts to what price does to someone who can actually anticipate its next logical move. So the only question left is this: now that you have this framework, what are you going to see on the charts tomorrow?